Hi everyone, I'm Caitlyn, and today I'll be talking to you about the revenue recognition principle. So, you may be thinking, what is the revenue recognition principle? Well, put simply, the revenue recognition principle is a principle that revenue should be recorded when it is earned, not just when the cash is received. So, now that we know what the revenue recognition principle is, you may be thinking, when do we use this principle in accounting? Well, the revenue recognition principle is used when constructing the statement of comprehensive income, also known as the income statement, which reports the revenues and expenses for a business and the resulting profit or loss. The revenue recognition principle is also used when adjusting journal entries, which are accrual-based. The accrual basis of accounting is an application of the revenue recognition principle, that is, that revenues are recorded when they are earned, and the matching principle, that is, that expenses are recorded in the time period they are incurred.
Now we'll go through some examples of the matching principle in action.
On the 6th of December, your neighbour, Mr. Bean, gives you $50 and tells you that he's going down the coast on the 6th of January and needs his teddy minded for a day. So, we know that Mr. Bean pays you $50 on the 6th of December. However, it is not until the 6th of January that you provide the service of minding teddy. So, when should we record the revenue? Well, we record the revenue on the 6th of January, of course. Why, you may ask? Because although the cash was received in December, the service was not completed and therefore the money was not earned until January. Also, did Mr. Bean pay you before or after the service of minding teddy? Well, as we can see, Mr. Bean paid you $50 before you minded teddy. This is known as deferred revenue. Deferred revenue is when the cash is received before the revenue is earned. Now we'll look at another example. On the 14th of November, Homer Simpson drops off his car at a mechanic because he has a flat tire. The mechanic replaces his tire, and Homer picks up his car and tells the mechanic that he conveniently left his wallet at home. Homer promises to pay the mechanic at a later date for the replacement tire. However, it isn't until the 14th of December that Homer finds his wallet at home and the payment is received by the mechanic.
So when do we record this revenue? The 14th of November, of course, because the revenue is earned when the service is provided to Homer, not when the mechanic receives the cash. Also, did Homer pay before or after the service of replacing his flat tire? Homer paid the mechanic after he provided the service of his new tire. This is known as accrued revenue. Accrued revenue is when the service is provided before the payment.
Fact time.
Revenue is recorded when it is earned.
Accrued and deferred revenue only exist under the accrual basis of accounting. Deferred revenue is when cash is paid before the service. Accrued revenue is when cash is paid after the service.
Thank you.